Something unprecedented is happening in the silver market right now, and most investors have no idea it's coming. Within the next 7 to 10 days, you're going to walk into your local bullion dealer or visit their website, and you'll discover something shocking. Those standard 1-ounce silver bars you've always been able to buy, they're gone, and they won't be back for weeks. There isn't a temporary glitch. It's not a shipping delay. What we're witnessing is an industrial silver vacuum, a complete restructuring of how physical silver flows from refineries to end users. And if you're planning to buy silver as an investment, you need to understand what's happening before it's too late. Let's start with the current reality. Silver prices recently reached an all-time high of $64.20 per ounce on December 11, 2025. But that's just the headline. The real story is hiding beneath the surface in the physical market. Right now, delivery times for standard 1-ounce silver bars have exploded from the normal 2 to 3 business days to 3 to 4 weeks. Some dealers are quoting 4 to 6 weeks, and others have simply stopped taking orders altogether. Meanwhile, premiums over spot price, the extra amount you pay above the raw silver value, have surged from the historical range of $2 to $3 per ounce to $6 to $8 or more. But here's what makes this situation different from past supply crunches. The silver market is experiencing its 5th consecutive year of supply deficit, with the cumulative shortfalls totaling almost 820 million ounces since 2021. That's nearly an entire year of global mine production that has simply vanished from above-ground inventories. The driving force behind this supply vacuum isn't investment demand. It's industrial buyers, and they're operating with an urgency we've never seen before. Industrial silver demand is projected to surpass 700 million ounces for the first time in 2025, driven by 3 massive sectors that simply cannot function without silver. Solar energy is the biggest consumer, with 520 gigawatts of new solar capacity planned for 2025, and each gigawatt requiring approximately 500,000 ounces of silver. The solar industry alone needs around 260 million ounces this year. That's nearly 1/3 of all mined silver production. And newer solar technologies like TOPCon and HJT cells actually use 20 to 30% more silver than traditional panels. Electric vehicles are the second major driver. EV production is rising from 10 million units in 2023 to an estimated 16 million in 2025. Each EV contains 25 to 50 grams of silver, double what traditional vehicles use. That's an additional 5 to 10 million ounces of demand that didn't exist just 2 years ago. Then there's the electronics and semiconductor sector, consuming approximately 255 million ounces in 2025, up from 240 million in 2024. AI infrastructure, 5G deployment, and general electronics manufacturing are all silver-intensive. Here's the critical insight. Industrial silver demand is price inelastic. Manufacturers keep buying regardless of price increases because silver represents only 6 to 8% of their final product costs. If you're building a solar panel or an electric vehicle, you're not going to halt production over a few dollars of silver per unit. The contract penalties and production delays would cost far more than paying up for silver. What's happening right now is a fundamental restructuring of silver distribution channels, and it's squeezing retail investors completely out of the supply chain. Industrial buyers have figured out they can't rely on traditional markets. They're now contracting 6 to 12 months of silver supply directly from refineries, essentially booking production before it's even refined. Refineries have responded by shifting their allocation priorities, dedicating 50 to 60% of production to industrial contracts. up from previous patterns where large bars dominated output. This means the traditional flow of silver, from mines to refineries, to wholesalers, to retail dealers, has been disrupted. Industrial buyers are intercepting the silver at the refinery level, leaving retail products like 1-ounce bars and coins scrambling for whatever remains. The situation became critical when over 500 million ounces of silver were stockpiled in the United States due to tariff concerns, while London exchange inventories ran dangerously low. This geographic dislocation, combined with years of supply deficits, created extreme stress in the physical delivery system. The US Mint provides a perfect example of this pressure. Through November 2025, it sold over 40 million Silver Eagles, near record demand, but now faces silver supply constraints that limit production capacity. Even if silver prices double tomorrow, there's a hard limit on how quickly supply can respond. Refining capacity is not easily expandable. Building new refining facilities takes 2 to 3 years and requires specialized equipment, environmental permits, and substantial capital investment. Mine production is only expected to grow by 2% in 2025 to reach 844 million ounces, and that modest increase won't come close to closing the supply gap. Approximately 70% of mined silver comes as a byproduct of base metal or gold mining, meaning primary silver supply is largely determined by demand for other metals, not by silver prices alone. If you're thinking about buying physical silver, understand that the market you knew last month no longer exists. The disconnect between paper silver prices and physical availability is widening daily. While futures contracts might show silver at today's spot price, actually obtaining physical metal now requires significant premiums and extended waiting periods. For investors who've been waiting for the right time to buy, that window is closing rapidly. The signs are unmistakable: extended delivery times, surging premiums, dealers limiting quantities, or suspending sales entirely. These are indicators of severe supply pressure that typically precede much larger price movements. The question isn't whether this supply squeeze will ease. It will eventually, perhaps in 3 to 6 months, under favorable conditions. The question is whether you want to pay today's premiums and wait 3 weeks, or pay tomorrow's premiums and wait even longer. This is not financial advice. But the industrial silver vacuum is real. It's accelerating, and within a week, most investors are going to discover they can't simply buy 1-ounce bars anymore. The silver market is undergoing a fundamental shift where industrial demand is increasingly dominating, and investment demand is being subordinated. The metal is still out there, but increasingly it's going into solar panels, electric vehicles, and semiconductors, not into retail investors' hands. By next week, you'll see exactly what that means when you try to buy that 1-ounce bar.